Introduction to Banking, Retail, Corporate, and Investment. Hi, my name is Christopher. Welcome to this journey through the banking world. Today we are going to study the chapter Basics of Corporate Banking. In this chapter, we'll explore what corporate banking is, what makes it different from other types of banking, and the services it provides to businesses. We will see how corporate banking supports companies' financial operations, funds their projects, and manages their risks. By the end, you'll have a clear understanding of why corporate banking is vital for the economy. What is corporate banking? Corporate banking focuses on providing specialized banking services to business entities. These clients range from small and medium enterprises, SMEs, to large multinational corporations. Unlike retail banking, which serves individuals, corporate banking addresses complex financial needs such as large-scale loans, cash management, and international transactions. Its key characteristics are higher transaction values, customized solutions, and relationship-based service. The primary objectives are to support business growth, facilitate operations, and manage business risks. Core services for businesses. Corporate banks offer a variety of services tailored for businesses. These include specialized business accounts with higher transaction limits and integrated cash management. They provide credit facilities such as overdrafts, term loans, and revolving credit lines. For companies working globally, corporate banks offer foreign exchange and international payment services. Each of these services is designed to meet specific operational and strategic needs of businesses. Working capital financing. Working capital financing helps companies manage daily operational expenses and short-term financial needs. It is calculated as current assets minus current liabilities. This type of financing bridges the gap between paying suppliers and receiving payments from customers. Examples include overdraft facilities, which let businesses withdraw beyond their account balance, invoice financing that advances money against unpaid bills, and inventory financing using stock as collateral. These tools help businesses maintain smooth operations. Project financing. Project financing is used for major infrastructure and industrial projects. It focuses on the project's future cash flows as the main repayment source, rather than the borrower's overall financial strength. The process includes project assessment to study feasibility, structuring the financing with multiple lenders and investors, and implementing disbursements based on milestones. Continuous monitoring ensures the project stays on track. This method is common in large-scale energy, transport, and industrial projects. Trade finance. Letters of credit. A letter of credit, LC, is a guarantee from a bank that a seller will receive payment from a buyer if certain conditions are met. It reduces payment risk, especially in international trade. The bank acts as an intermediary, ensuring both buyer and seller meet the agreed terms. Payment is only released when all LC conditions are satisfied. This builds trust in cross-border transactions. Trade finance, bank guarantees. A bank guarantee is a promise by the bank to cover a debtor's obligation if they fail to pay. Examples include bid bonds for tender participation, performance guarantees to ensure contract completion, and advance payment guarantees for securing prepayments. Financial guarantees also cover loan repayments. These instruments give businesses confidence in dealing with new partners or large contracts. Cash management services. Cash management services help businesses optimize liquidity and streamline payments. Collection services include lockbox facilities, electronic receivables, and direct debit arrangements. Payment services may involve bulk payment processing, electronic fund transfers, and automated payroll. Liquidity management includes cash pooling and sweep accounts for interest optimization. Real-time reporting and analytics support better financial decision-making. Corporate advisory services. Corporate banks also provide advisory services beyond traditional products. Debt advisory guides companies on structuring and refinancing loans. Treasury management advice helps manage interest rate and currency risks. Investment banking services may support mergers, acquisitions, and capital raising. Industry expertise provides sector-specific insights and benchmarking, helping businesses compare their performance with competitors. Risk assessment in corporate banking. Corporate banks use detailed methods to evaluate clients before granting credit. Financial analysis examines balance sheets, cash flow, and profitability. Industry assessment looks at market trends and competitive position. Management evaluation considers the leadership team's experience and capabilities. Collateral analysis assesses the value of assets offered as security to determine safe loan-to-value ratios. Key risk metrics. Important metrics include the debt service coverage ratio, DSCR, which measures if income can cover debt payments. A value above 1 is preferred. The loan-to-value, LTV ratio compares loan size to collateral value. Lower is safer for the bank. The debt-to-EBITDA ratio shows how many years of earnings are needed to repay debt. Lower is better. The interest coverage ratio indicates how easily a company can pay interest. Higher values mean lower risk. Corporate banking versus retail banking. Corporate banking uses dedicated relationship management teams, while retail banking often uses branch and digital managers. Corporate clients receive highly customized services, while retail customers get standardized offerings. Both types aim to manage accounts and transactions efficiently, but their scale and complexity differ greatly. Corporate relationships are more strategic and long-term. Retail banking focuses on mass market efficiency. Corporate banking versus investment banking. Corporate banking focuses on lending and day-to-day financial services for businesses. Investment banking handles capital raising, securities issuance, and mergers and acquisitions. Corporate banking revenue comes mainly from interest and fees. Investment banking earns from advisory and underwriting. Risk assessment in corporate banking focuses on business fundamentals. In investment banking, it depends on market conditions and deal structures. Many large banks operate both as part of corporate and investment banking, CIB divisions. Digital transformation in corporate banking. Corporate banking is adopting digital tools to meet client expectations and improve efficiency. Online banking platforms allow real-time monitoring and approvals. API integration connects bank systems with client systems for automation. Data analytics offer insights into cash flow and spending to optimize operations. This transformation is reshaping how banks interact with corporate clients. Career paths in corporate banking. Entry-level roles include relationship manager associates who support senior managers. Relationship managers handle client portfolios and recommend solutions. Senior relationship managers work with large clients and lead teams. The head of corporate banking oversees the division's strategy and key relationships. Specialized roles exist in credit analysis, product management, and advisory. Summary: basics of corporate banking. Corporate banking provides specialized services to businesses, from SMEs to large corporations. Core services include business accounts, financing, trade support, cash management, and advisory. Risk assessment is thorough, using financial, industry, and management analysis alongside key ratios. By offering financial infrastructure and expertise, corporate banking supports business growth and economic development. It is a vital link between banks and the corporate world.